Hello and welcome. My name is Dr. Cheryl Dunn, and this demonstration is for a problem in financial accounting where we're asked to calculate a current ratio. And so the information that we're given in the problem you see here. So first take a look at the problem. Now as you can see, I've copied the information about the account balances that we were given here so that they'll be handy and I can check mark them as we go. We're going to first write the equation for the current ratio. And a current ratio is used to determine liquidity, how able a firm is to pay back their short-term debts as they become due. And so we take a look at their current assets in relation to their current liabilities. Current assets are the things that a company owns that have value that they're going to turn into cash or use up in a relatively short time frame, typically less than 1 year. And current liabilities are the debts the company has that are going to come due in that 1 year. So if we have enough assets that we expect to turn into cash relatively quickly, if we have more of those than we have current liabilities, then we're in pretty good shape. We divide them instead of just subtracting them. If we subtract them, we call that working capital. And it's not as easy to compare across companies if you're just looking at working capital. But if you're looking at the current ratio, the current assets divided by the current liability is scales for size, so it's more comparable across companies. So in this case, what we need to do is figure out which of these accounts represent current assets and which of them represent current liabilities and which of them are irrelevant to this problem because they're not either one of those things. And if they're a current asset, we're going to include them in the numerator, and if they're a current liability, we're going to include them in the denominator. So first of all, net income, that is not a current asset nor a current liability, so we're not going to include that. Cash is a current asset. And so we're going to include that in our numerator. So our numerator is going to consist of 40,000. And then let's see if it includes anything else. Accounts receivable, that's the amounts that a customer owes to a company that it will collect from them for services they provided or for goods that they sold them. So that is a current asset, and we're going to add that 55,000 in our numerator. Inventory is also a current asset. That's the goods that we are going to sell to customers that will then turn into cash, and so it's going to become cash within a year typically. And so we'll include that 63,000 in our numerator. Land is not a current asset. Land is a long-term asset. It's going to last more than a year, and so we're not going to consider that in this particular ratio. Capital stock is owner's equity in the company. It's not an asset at all, so we're not going to deal with that. Prepaid rent represents rent that the company has paid in advance of when it's due. Therefore, the payment provides future value because it's providing the occupancy of space or the use of some kind of equipment that's being rented. We're not sure what they're renting here, but it could be either one. That is a current asset, and so we will include that in our numerator. Okay, accounts payable is a current liability, so we will include it in our calculation. It's not going to go on the numerator, however, it's going to go on the denominator. So we're going to write 43,000 in the denominator. Notes payable that's due in 3 years is a long-term liability. So while it is a liability, it's not current, and therefore we won't consider it for this problem. Salaries payable typically is a short-term liability. Our employees want to get paid right away. They don't want to wait over a year to get paid. So typically our salaries payable is due within a couple weeks. So it is a current liability we will include in the denominator. And then retained earnings is an owner's equity, represents the earned capital of the company. That's not a current asset or current liability, so we will not include it in this ratio calculation. So all we have left to do is the math. So 40,000 plus 55,000 is 95,000. Plus 63,000 makes 158,000, plus 12,000 equals 170,000. And then 43,000 plus 32,000 gives us 75,000. So we basically have a current ratio of 170,000 divided by 75,000, which gives us a current ratio of 2.27 to 1. That indicates that we have over twice as many current assets as we have current liabilities. So this company that we're representing appears to have ample liquidity, ample ability to pay its short-term debts as they come due. It has ample liquidity. Thank you for viewing this demonstration. I hope you found it helpful.